Let me ask you something. What if you could own a piece of a bank? Or a tech company? Or even the company that makes your morning coffee? Not the whole company, just a tiny piece. Well, that's exactly what a stock is. And today I'm going to explain it using something very Canadian, a maple syrup farm. All right, Colony, here's the situation. I have a dream. I want to build the largest maple syrup farm in the entire forest. I'm talking hundreds of maple trees, thousands of buckets, barrels of syrup, the works. But there's a problem. Right now, I only have one tree and one bucket. That's not exactly a syrup empire. So I need money to grow. Now I have two choices. Option one, I go to the bank and ask for a loan. But loans mean debt. I'd have to pay interest, and if the farm fails, I'm still stuck paying the bank. Not great. Option two is something much smarter. Instead of borrowing money, I can sell small pieces of my farm to other animals in the forest, and those pieces are called stocks. Let's make this really simple. Imagine my maple syrup farm is worth $10,000. Instead of owning it all myself, I divide the farm into 1,000 tiny pieces. Each piece represents ownership in the farm. If I sell one piece for $10 and you buy it, congratulations, you are now a shareholder. You officially own a tiny part of my maple syrup business. That means you own a piece of the maple trees, the buckets, the syrup barrels, and even the profits the farm makes. And that tiny ownership piece is called a stock. Now here's why companies do this. By selling those 1,000 pieces, I raise $10,000. That money helps me buy more maple trees, buy more buckets, hire worker beavers, and produce way more syrup. The farm grows faster, and because the farm grows, your little ownership piece can grow in value too. That's why investors buy stocks. They're betting that the business will grow over time. There are two main ways investors make money with stocks. Let's start with the most common one. 1. Price growth, or capital gains. Remember when you bought your piece for $10? Well, imagine 5 years pass. My maple syrup farm explodes in popularity. Animals all over the forest are buying our syrup. Now new investors want to buy a piece of the farm too. But there's a limited number of pieces, so they're willing to pay $50 for your piece. You bought it for $10, you sell it for $50, that $40 profit is called a capital gain. 2. Dividends. Some companies also share their profits. Let's say the farm makes $5,000 in profit this year. Instead of keeping it all, I might send a small portion of that profit to the shareholders. So if you own pieces of the farm, you might receive a small payment just for owning it. That payment is called a dividend. Think of it like a thank you reward for being an owner. Now here's the important part. Stocks don't always go up. Sometimes the syrup harvest is bad. Maybe fewer animals buy our syrup. Maybe another farm becomes more popular. When that happens, the value of your ownership piece can go down. That's the risk of investing. But smart investors don't panic. Instead of buying just one company, they often buy many different companies. It's like owning a whole forest instead of just one tree. So, to recap, a stock is simply a small piece of ownership in a company. Companies sell stocks to raise money to grow. Investors can make money through price growth and dividends. But like any investment, there's always risk. The key is starting small, being patient, and thinking long-term, because the biggest forests aren't grown overnight. If you want simple investing explanations like this, subscribe to Beaver Invests. And in the next video, I'll explain how you can buy an entire forest at once using something called an ETF. See you at the pond!